Hello class, this is Professor Reynolds, and this would be the second video for Module 4. I'm going to be talking about problem 11.5. There are other problems that are similar to this, but if you can get through 11.5, that should help you with all the other problems. In the first video, we just went over what happens at different dates, depending upon what the accounts receivable or accounts payable, what currency is specified. So if you're an American company and you buy something overseas and it's in dollars, then it's not a problem. But if it's in a foreign currency, then the American company has to make adjustments to the account balances at different dates. In the first example, there was no hedging. In this example, we are talking about hedging. So if you look on the notes page, you can see that there are going to be dates where you make adjustments to the balance sheet. And when you hedge, basically you're saying that I am going to sell or buy a certain currency on a certain date for a certain amount of dollars. So if you're selling, then what you're going to create is a receivable, but that receivable is going to be in dollars. So that receivable, the balance isn't going to change. But if you're going to sell something, then you have a payable, and that payable is to the dealer, and that dealer will be paid in a foreign currency. So because that's in a foreign currency and because you have to convert that to dollars, when you need to record that amount or adjust that amount, the accounts payable to the dealer in this situation is going to need to be adjusted. So we'll go through this, and here are some accounts here, FC payable to exchange dealers. So that's going to be something that fluctuates because that's foreign currency payable to the exchange dealer. So that is going to be an obligation in whatever the foreign currency is. So every time you adjust your balance sheet, you're going to have to make a change to that. Dollars receivable from exchange dealer, that isn't adjusted because those are in dollars. The asset or the liability is most likely going to be in foreign currency, so you'll need to make an adjustment to that as well. And the investment in foreign currency represents the foreign currency, so again, that will need to be adjusted as the exchange rate changes. In each unsettled foreign currency transaction, there are 3 stages of concern to the accountant. At the date the transaction is first recognized, so you have to make journal entries for that. At each balance sheet date, that's when you need to convert whatever foreign currency obligation that is due, you have to convert that into dollars. And then at the settlement date, again, you have to do the same conversion. And then you settle the account, so there are a little more transactions involved there. All right, so let's go to 11.5 and let's start out. And what is happening here is we're going to use a foreign contract to sell foreign currency on the date the receivable is expected to be due. So we're going to sell a product to a vendor. I would like to make one other note. Right now I'm using Clipchamp and I haven't upgraded, so I only have 30 minutes. So hopefully this won't take 30 minutes. But if it suddenly stops, I'll get through as much of the journal entries as possible. All right, so we are going to sell something, and we're going to record the sell. We're going to record the sell on the date that we make the sell, but the receivable isn't going to be paid until a later date, and that date is going to be across a year, so we're going to have to make adjustments to the balance sheet. So when we make adjustments, when we change the payable or the receivable, we're going to tie that to the spot rate because that's what we could go out and get currency at that rate. Now, the hedging is going to be tied to the forward rate. When it is redeemed, the forward rate and the spot rate are going to be the same, so there's really going to be no adjustment at that point. All right, so we sell a product and we're going to sell it for 48,000 pounds. And so 48,000 pounds, we convert that, and you convert that to 76,901, which of course is the spot rate on the day that we make the sell times the pounds. And so that's not going to change. Our sales amount's always going to be $76,901. But our accounts receivable, again, that's going to be due in pounds. So as the exchange rate changes, we're going to have to make that adjustment when we measure the balance sheet. The other thing we're going to do is, again, we have um, executed an agreement where we are going to sell 48,000 pounds to a dealer. So we're going to receive 48,000 pounds. We're going to sell 48,000 pounds. So those are going to match up. The only cost is going to be whatever fee we have to pay. So the forward rate is going to be different from the spot rate, and that really is going to be the fee that we're going to have to pay. All right, so this dollars receivable means that we're going to be able to sell it for 76,416. And so that is the forward rate of 1.5920. In other words, that's the rate for which we can sell on 3/125. So we have this dollars receivable, so that's not going to change, but this is going to be where we are going to provide 48,000 pounds to a dealer. So when we have to measure that, obviously that balance is going to change. And those changes are going to be transaction loss or gain. So we come upon 12/31/2024, and so we need to make sure that the balance sheets are up to date. So the first thing we're going to do is look at the accounts receivable. So the accounts receivable um, basically went down, okay? And we know that because we're going to look at this spot rate. The spot rate went down, okay? So we get less dollars per pound. So we're going to incur a reduction in our accounts receivable balance. So now it's going to be the 48,000 pounds times the 1.5820. So that's now um, 95, 75,000 or 75,936. So the original amount was, of course, 76,416, as you can see here. So we're going to have to reduce that. And you can see over here, the accounts receivable balance is going to be a credit. All right. And the other part of this entry is going to be, of course, a loss, a transaction loss. The other thing we have, of course, is we have the 48,000 pounds that we are going to give the dealer. Now, this is tied to the spot rate. So we're going to look at here, and the 75,840, you can see the 48,000 pounds times the 1.58 spot rate. All right. So our payable is going to be the opposite direction because our payable is going to be less. Okay, we have a receivable that's left, but we also have a payable less. So when the receivable is left, the other side of the entry is a transaction loss. When a payable is less, the other side of the transaction is payable a gain. And again, these are different because the accounts receivable is tied to the spot rate and the payable to the dealer is tied to the forward rate. So at this point, the forward rate is 1.58. That's where we get the 75,840. Okay, so that's what's due at the end of the balance sheet date. Okay, so now we come to March 1st, 2025, and we're going to settle these accounts. So we have to again update the accounts receivable. And so that is going to be the 16543 times the 48,000 pound. And so now our receivables balance is 79,406. Well, then we have to debit the balance by 3470. All right. And so the other side of that is going to be a transaction gain. Okay. So now we've got the foreign currency. So we've got 48,000 pounds that we're going to deliver to the dealer. So since that's in pounds, we've got to convert that to dollars. And again, that's going to be the 48,000 times the spot rate as well. And so that's going to be an increase in a payable. All right. So the increase in receivable is a transaction gain because we've got an asset going up, but it's going to be offset by an increase in a payable. So that's a loss. Okay. So those two losses come down to here. All right. So now we are going to deliver our investment to the dealer, okay? And so we are going to have eliminate our accounts receivable, or I'm sorry, um, we are going to get 48,000 from our uh, customer. All right. So that's going to decrease the AR balance because the customer pays us. So we're going to have a credit to the accounts receivable. That balance goes away. And now we are in possession of 48,000 pounds. And so we're going to take that 48,000 pounds and we're going to deliver that to the dealer. Okay. And so that's really the investment in foreign currency. We're going to give that to the dealer, and then the dealer's going to give us the 76,416 cash, which he agreed to do at the beginning. All right. And so this is the payable to exchange dealer. So when we get we're going to give up the cash, and then we're going to give up the pounds. We're going to give up the pounds. So we've got the foreign currency payable to the dealer, which we've given them. So this goes away, and 48,000 pounds is now worth 79,406. We've got the other pounds, okay, that we received from the customer. All right, so that's basically going to be a wash. They get 79,406 in dollars effectively, or basically they both get 48,000 pounds. All right. And so the dealer owed us 76,416. He gave us cash 76,416. And so now what ended up, we have a basically a fee, which is a transaction loss overall, and we have uh, collected the cash that we expected to receive, the 76,416. So that's a case where we have made a sell and we haven't established accounts receivable. You can see here the page numbers. This is where you can go if you want a little more detail. Page 539 for that one. So this one is something where we're going to sell something to someone. We've agreed to sell it on a certain date. And we still want to hedge that. Okay, so we want to hedge and say, all right, we're going to sell that. So then we're going to receive something in return. So we're again going to hedge that. So again, we go back to the dealer and they're going to give us 76,416 in dollars. And we're going to give them 48,000 pounds. All right. So at the end of the year, again, we have this 48,000 pounds that we have to adjust. All right. And so we do the same thing because the rate went down. We have to adjust the rate for the FC payable, just like we did in the previous example. Okay, pound and pound, so we have to be adjusted. And then we have this firm commitment of the 48,000 pounds we're going to get from the customer. Okay, and so we have to go ahead and adjust that as well. And we are using the, let's see, in this case, again, because it's foreign currency that we're going to get, we're going to look at the forward rate because of what it's going to be at that point. So both of these are really going to be the forward rate, and that's why in this case they're equal. All right, so we've made adjustment for that. And now we've come to the end and we've got the payable to the dealer again. So we are going to pay them 48,000 pounds because the exchange rate has changed and gone up. Our payable increased, so we make that same adjustment that we did before. Same thing with a firm commitment. That's the 48,000 pounds as well. So the investment, so we get the 48,000 pounds, 79,406. All right. And we are going to book the original sales price because that's what we're obligated to do, the 76,416. So the difference between what the pounds were worth and what the sales were is going to be the firm commitment, because that's the difference. And so the firm commitment is then going to have an offset of these foreign exchange losses and or this firm commitment. Okay, so the last part again is that we collect cash from the exchange dealer. We deliver, and that's the dollar amount that we were due, so that cancels out. And then we provided the 48,000 pounds, which we have adjusted to reflect the current exchange rate. So the 79,406, just like in the first example, all right, that's equal to the 16,543 times the 48,000 pounds. And so in this case, we've hedged this, but this is something where we had a forward commitment. And then here's just a hedge for future exchange rate fluctuations. Again, same process is that we are going to get a 76,416 from the dealer. We've got 48,000 pounds. Because we really don't have a sales obligation, this is just basically we're going to hedge currency. So here, all we really need to do is to upgrade the payable to the dealer. All right, again, this is in pounds. So we are going to, because our exchange rate changed favorably, all right, went down to 1.5820, because we have to adjust that. So accounts payable decrease, that's a debit. So the credit goes to transaction gain. All right, and then when we do this, of course, we have the transaction loss. That's a 48,000 pounds. So the 48,000 pounds exchange rate has gone up. So we have to increase that 35.66, just like we did in the previous examples. All right, and so that brings the balance back to 79,406. All right, so the investment in FC is back to 79,406. All right, so we are going to pay cash for this investment. And then we are going to give cash. Okay, so the 48,000 pounds that we've had to pay, of course, is going to be this amount. So this is 48,000 pounds. All right. So we've sold that, and now we're getting cash for that amount. And then this is the similar one. The dealer, we have 79,406, 48,000 pounds equals 48,000 pounds here. All right. And so we're getting cash. We're releasing this obligation, the dollars that the dealer owes us. Okay. We're giving this 48,000 pounds to the dealer, and then our investment in foreign currency, which is the 48,000 pounds, that goes away.